I have seen people stuck around the same credit score for months. They pay on time, they keep their balances low, they stop applying for random credit, and still their score barely moves. Then suddenly, out of nowhere, the score jumps. Not by 3 points, not by 5 points. Sometimes 30, 40, even 60 points faster than they expected. And most people think that jump is random. It is not. Your credit score does not always grow in a straight line. Sometimes it feels slow. Then your profile hits a certain point. And once that point is crossed, the scoring model starts treating you differently. That is why some people go from the low 700s to the high 700s faster than they went from 600 to 650. It is not magic. It is not luck. It is your credit profile finally reaching certain tipping points. So in this video, I am going to show you 3 signs that your credit score may be getting ready to jump. These are not the basic tips everyone repeats. Yes, paying on time matters. Yes, keeping balances low matters. But these 3 things are the hidden points where your profile starts looking stronger to lenders. By the end of this video, you will know where your profile stands, what may be holding it back, and what you can do to speed up the next jump. So let's get into it. The first sign your score may be ready to jump is when your credit profile is no longer new. And the big marker here is your average age of accounts. Most people only look at their score. They do not look at the age of their credit file. But credit age matters a lot because lenders do not just want to know if you paid on time last month. They want to know if you can stay consistent over time. That is why a person with 6 months of perfect payments is not viewed the same as a person with 3 years of perfect payments. Both people may be paying on time, but one has proved it longer. And that is the difference. When your accounts are still new, your score can feel stuck. You might be doing everything right. No missed payments, low balances, no collections, no charge-offs, no crazy applications. But the score still moves slowly. That does not always mean you are doing something wrong. Sometimes your profile is just young. The scoring model is still waiting to see if your good habits are temporary or consistent. But once your average account age starts crossing important milestones, your profile can start getting rewarded faster. One of the biggest milestones is around the 2-year mark. When your average age of accounts starts moving past that point, you are no longer looking like a brand new borrower. You start looking more established. You start looking more stable. And stability is what lenders like. This is where people get confused. They think their score jumped because of one payment they made. But sometimes the real reason is that their profile finally aged into a stronger category. The work was already done. The score was just waiting on time. That is why patience is a real credit strategy. But here is where people mess it up. They close old accounts too early. They pay off a card and think, I do not use this anymore, so I should close it. That can be a mistake. Because old accounts help your credit history. They help show how long you have been managing credit. Now, closing a card usually does not erase it from your report immediately. But once an account is closed, it stops aging as an active account. And later, when it falls off your report, that history can disappear. So if you have an old credit card with no annual fee, keeping it open can help your profile keep aging, even if you only use it once in a while, even if you only put a small charge on it, even if you pay it off right away. The goal is to keep the positive history alive. Now, if the card has an annual fee and you do not want to pay it, do not rush to close it. Call the issuer first. Ask if they can downgrade it to a no-fee version. That way, you may be able to keep the account history without paying the fee. But there is one warning. If the account has serious negative history, like repeated late payments, charge-offs, or other derogatory marks, then you need to be careful. Do not make decisions blindly, because every profile is different. Sometimes keeping an account helps. Sometimes cleaning up the negative history matters more. That is why you have to look at the full report, not just one account. Now, here is the main point. The first tipping point is not about doing something dramatic. It is about letting the positive accounts you already have mature. Your score may not jump today. It may not jump tomorrow. But if you keep the accounts open, keep them clean, and keep paying on time, time starts working for you. That is sign number 1. Your credit profile is aging into a stronger position. Now, the second sign your score is about to jump is when your utilization drops below the real danger zone. And this is where most people get the advice wrong. You have probably heard people say, keep your utilization under 30%. That advice is not completely wrong. Under 30% is better than maxing out your cards. But under 30% is not where the strongest jump usually happens. That is just the basic line. The real power is usually below 10%. And for many profiles, the sweet spot is even lower, somewhere around 1 to 6%. Let me explain. If your total credit limit is $10,000 and your reported balance is $3,000, your utilization is 30%. That may not look terrible, but it still tells the scoring model you are using a decent amount of your available credit. Now, if your reported balance drops to $1,000, your utilization becomes 10%. And if your reported balance drops to $300 or $500, now your utilization is in a much stronger range. That difference can be huge. For some people, going from 30% utilization to under 10% can create a noticeable score jump. Not because they got a new account, not because they removed a collection, but because their revolving debt suddenly looks less risky. Credit scores are heavily affected by how much of your available credit you are using. The more you use, the more risk you show. The less you use, the safer you look. But here's the part most people miss. Utilization is not only measured across all your cards together, it can also be measured on each individual card. So you might have 5 credit cards. Your total utilization might look fine. But if one card is maxed out, that one card can still hurt you. For example, let's say you have $50,000 total credit limit across all cards, and your total balance is only $5,000. That is 10% overall utilization. Sounds good, but if that full $5,000 balance is sitting on one card with a $5,000 limit, that one card is maxed out. That is a problem, because one maxed out account still makes your profile look risky. So the goal is not just to keep your total utilization low. You also want to avoid letting any single card report a high balance. Now here is the strategy. The first thing you do is pay your balance before the statement closing date, not just the due date. The due date and the statement closing date are not the same thing. The due date is when you must pay to avoid late fees and interest. The statement closing date is usually when the balance gets reported to the credit bureaus. So if you pay after the statement closes, the high balance may already be reported, and your score may drop even if you pay in full by the due date. This is why people get confused. They say, I paid my card on time, so why did my score drop? Because the card reported a high balance before you paid it down. So if your statement closes on the 25th, you may want to pay the balance down a few days before that. Then when the issuer reports, your balance looks lower. That can help your utilization look better. The second strategy is to ask for credit limit increases. This can help because if your limit goes up, but your balance stays the same, your utilization drops automatically. For example, if you have a $1,000 balance on a $2,000 limit, that is 50% utilization. But if the limit increases to $5,000, that same $1,000 balance becomes 20% utilization. You did not even pay the balance down, but your utilization improved because your available credit increased. Now, before you ask for a credit limit increase, check if the issuer uses a soft pull or a hard pull. Some issuers allow you to request increases inside the app with no hard inquiry. Others may pull your credit. So always check first. Do not create unnecessary inquiries just to chase a limit increase. The goal is to improve the profile, not damage it. Also, do not ask for increases on accounts that are in bad standing. If the card is late, over limit, or recently opened, wait. Ask when the account looks strong. On-time payments, low balance, good history, that gives you a better chance. Now here is sign number 2 in simple words. If your balances are dropping below 10%, and especially if no individual card is reporting high, your score may be getting ready to move. Because the model sees less risk, and lower risk usually means a stronger score. Now the third sign your score may be ready to jump is when your credit mix starts looking more complete. Most people build credit with credit cards only. And credit cards are useful, but they are only one type of credit. They are revolving accounts. You use them, you pay them down, then you can use them again. But lenders also like to see that you can handle installment credit. That means loans, a car loan, a personal loan, a student loan, a mortgage, a credit builder loan, something with a fixed balance and scheduled payments. When your profile has both revolving credit and installment credit, it tells a stronger story. It shows you can manage different types of debt, not just credit cards. But here's the important part. Do not open a loan just to chase a few points if you do not understand it. A loan is still debt. It still has terms. It still has payments. It still has cost. But if your profile has no installment history at all, a low-cost credit builder loan can sometimes help add that missing piece. A credit builder loan is one of the safer ways people do this. Instead of the lender giving you the money up front, the money is usually held in a savings account while you make payments. As you pay, you build payment history. At the end, you get access to the funds. So it can help build credit and savings at the same time. But the real score boost with installment loans often happens later, not always when you first open the loan. When a loan is brand new, you still owe almost the full balance, so the scoring model does not reward it as much. But as you pay it down, the loan starts looking better. And when it gets close to being paid off, your profile may get a bigger boost. Why? Because the model sees that you took a loan and successfully paid most of it back. That shows follow through. That shows consistency. That shows lower risk. For example, if you opened a $10,000 loan and now the balance is down to $1,500, that looks much better than owing $9,800. The lower the balance compared to the original loan amount, the better the loan can look on your profile. This is why people sometimes see a jump when their installment loan gets near the end. They did not do anything new. They just kept paying it down. The profile finally started getting rewarded. Now, if you have a car loan, personal loan, or credit builder loan that is close to being paid off, do not rush without thinking. If you are planning to apply for something soon, like a mortgage, auto loan, or high-limit card, it may be worth letting the loan report a few more low-balance payments before closing it out. But if paying it off early saves you money and you are not applying for credit soon, that may be the better move. Credit strategy should not fight your real finances. Do not pay extra interest just for ego points. The goal is to balance credit score with financial sense. Now here is sign number 3 in simple words. If your profile has both revolving accounts and installment history, and your installment loan is paid down heavily, your score may be close to a jump. Because now your profile looks more complete. You are not just a person with cards. You are someone who can manage different types of credit over time. Now let's bring all 3 together. The first tipping point is age. Your accounts are no longer brand new. Your profile is starting to look established. The second tipping point is utilization. Your reported balances are dropping below 10%, and no individual card is reporting too high. The third tipping point is credit mix. You have more than one type of credit, and any installment loan is showing strong payment progress. When these 3 things start working together, your score can move faster. This is why some people feel stuck for months. Then one day, everything lines up. Their accounts age, their balances report low, their loan gets paid down, and suddenly the score jumps. It looks random from the outside. But it is not random. It is the result of your profile crossing the right thresholds. Now here's the warning. None of this works properly if your report has serious negative marks holding it down. Late payments, collections, charge-offs, repos, fresh delinquencies, high balances, too many recent inquiries. These things can act like anchors. You can have old accounts. You can have low utilization. You can have a good credit mix. But if negative marks are sitting on your report, they can still hold your score back. That is why credit building and credit repair are not the same thing. Credit building is adding positive data. Credit repair is fixing inaccurate, outdated, duplicated, incomplete, or unverifiable negative data. You may need both. If your report is already clean, focus on building, age the accounts, lower utilization, improve credit mix. But if your report has errors, you need to deal with those first, because you cannot build a strong score on top of a damaged report. So here's what I would do. First, pull all 3 credit reports. Do not just check one app. Look at Experian, Equifax, and TransUnion. Second, check for negative items, late payments, collections, charge-offs, wrong balances, wrong dates, duplicate accounts, accounts that do not belong to you. Third, check your utilization. Look at the total utilization and each individual card. Fourth, check your average age. See if your profile is still young or starting to mature. Fifth, check your credit mix. Do you only have credit cards? Or do you also have installment history? Once you know those numbers, you know what to fix. If your age is the issue, stop opening too many new accounts and let your profile mature. If utilization is the issue, pay balances before the statement closing date and request soft pull limit increases. If credit mix is the issue, consider whether a low-cost credit builder loan makes sense. If negative items are the issue, focus on disputing inaccurate reporting and cleaning the report the right way. That is how you build credit with a real plan. Not random hacks, not fake disputes, not opening 10 cards, not chasing every bank bonus. A real plan. Because your credit score is not just one number. It is a reflection of the story your report is telling. And the story lenders want to see is simple. You have experience. You use credit responsibly. You keep balances low. You pay on time. You can manage different account types. And you do not have recent negative behavior. When your report starts telling that story, your score can start moving differently. Now, let me make this very practical. If you want to trigger the next score jump, do these 3 things this month. Number 1, find your statement closing dates, not just your due dates, your closing dates. Then pay your cards down before those dates. Number 2, request credit limit increases on your best accounts, only if the issuer confirms it will be a soft pull. Number 3, stop closing old positive accounts. Keep them active if they have no annual fee and no negative history. Those 3 moves alone can put your profile in a much better position. And if you already have an installment loan that is almost paid off, keep an eye on how it reports. That final stretch can be powerful. Now, if you are watching this and your score is still in the 500s or low 600s, do not feel discouraged. These tipping points still matter. But your first job is probably cleanup. Get the negatives reviewed. Lower high balances, stop new late payments, build consistent payment history. Then these score jumps become much easier to unlock, because the higher your score gets, the more every detail matters. Going from bad credit to fair credit is one game. Going from 700 to 800 is another game. At that level, small things matter. One high balance can cost points. One new account can slow your age. One missed payment can destroy years of progress. So if your goal is an excellent score, you can not only do the basics. You need to understand the tipping points. Age, utilization, credit mix. These are the 3 signs that your score may be ready to jump. And once your profile is clean, these things can start working in your favor. So if your score feels stuck right now, do not assume nothing is happening. Your profile may be building pressure in the background. Your accounts may be aging. Your balances may be coming down. Your loan may be getting closer to that low balance stage. And once the numbers cross the right point, the jump can happen faster than you expect. That is how credit works. Slow, 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 then suddenly fast, but only if the foundation is clean. So before you chase a perfect credit score, make sure your report is not being held down by late payments, collections, charge-offs, or inaccurate information. Because if those negative marks are still there, they can cap your progress. And if your profile is clean, then focus on the 3 tipping points. Let your accounts age. Keep your utilization under 10%. Build the right mix of credit. That is how you stop guessing and start building your score with a strategy. And if you want to know the biggest mistake people make even when they pay their card on time, watch this next video. Because there is one date on your credit card statement that controls what gets reported to the bureaus, and it is not your due date.